Tomorrow, 15th December, everything starts with Nifty at 26,000. If this level holds, the market keeps its recovery alive. If it breaks decisively, the door opens toward 25,750, and sentiment changes very quickly. Bank Nifty will decide direction early. The 59,300 zone in the first 15 minutes will tell us whether buyers are serious or just reacting. Hold above it, and strength can extend. Fail below it, and the index can slide back toward 58,700. Stay with me for the next 20 seconds, because these levels are not just numbers. They are decision points where psychology, liquidity, and global cues collide. In just a moment, I'll break down exactly why today's rally happened, why it still needs confirmation, and how to prepare calmly for tomorrow's session. Let's begin with the global picture, because today's Indian market move did not happen in isolation. Over the last few sessions, global markets have been adjusting to a shift in tone from the US Federal Reserve. The message markets absorbed was simple: liquidity conditions may not tighten further in the near term. That perception alone was enough to cool bond yields, soften the dollar, and revive risk appetite across equities. When US yields ease, global money breathes easier. Risk assets, especially in emerging markets, get a temporary boost. That's exactly the backdrop Indian markets walked into today. US equity markets held firm overnight, even though leadership rotated internally. Technology showed fatigue, but broader indices stayed resilient. This matters because it signals rotation, not panic. Rotation keeps global liquidity engaged, panic drains it. Asian markets followed that lead cautiously. There was no euphoria, but importantly, there was no risk of liquidation either. That stable Asian handoff helped Indian markets open with confidence. Now here's the key connection to tomorrow. As long as US yields remain controlled and the dollar does not spike, India retains breathing room. But if either reverses sharply overnight, tomorrow's opening range in India becomes fragile. That's why I want you watching global cues not emotionally, but mechanically. If global markets stay calm, Indian levels matter more. If global markets wobble, Indian supports get tested faster. Now let's bring the focus home. Indian markets closed today on a strong note, with Nifty reclaiming the 26,000 zone and broader participation improving. This was important, not because it guarantees upside, but because it halts the momentum of the prior decline. From a fundamental perspective, today's move was driven by three forces. First, global liquidity comfort after the Fed tone shift. Second, relief buying after several sessions of selling pressure. Third, rotation back into cyclicals that benefit from risk appetite. However, here's the reality check: fundamentals did not change overnight. Earnings visibility remains selective. Domestic macro data still requires monitoring. And foreign institutional participation remains cautious. That's why today's rally must be treated as opportunity with discipline, not blind optimism. Now the technical structure. On the daily chart, Nifty bounced strongly from the 25,700 to 25,800 demand zone, a region that has repeatedly attracted buyers. The reclaim of 26,000 reduces immediate downside risk, but it does not automatically confirm a new trend. For trend confirmation, the market still needs acceptance above higher resistance zones with volume and breadth. Until then, we operate in a tactical environment, not a positional one. Bank Nifty mirrors this structure. It remains range-bound, oscillating between 58,700 support and 60,000 resistance. Today's close near the middle of that range keeps the index neutral to positive, but not free yet. Let's talk about where money actually went today. The strongest participation came from metals and autos. These sectors typically lead during early risk-on phases, and that's exactly what we saw. Metals benefited from two narratives. 1. Expectations of steadier global demand. 2. Currency dynamics that support commodity pricing. When global risk appetite returns, metals are often the first to respond. Autos saw selective strength as well. Cyclicals that benefit from economic optimism tend to outperform when markets sense stabilization rather than acceleration. This is not speculative chasing, it's measured rotation. Financials also contributed, particularly private banks, helping Nifty and BankNifty maintain structure. This is crucial, because rallies without financial participation usually fail quickly. On the weaker side, defensives and select pharma names lagged. This is not bearish, it's rotation. Money moving out of safety is what allows indices to stabilize after a decline. When you look at individual stocks, today's gainers shared a common trait: volume confirmation. Steel and commodity-linked names led the advance. Their charts showed clean intraday breakouts supported by expanding volumes. That's not accidental, it's institutional footprint behavior. On the losing side, the stocks that underperformed were largely those that either failed to reclaim short-term averages or saw profit-taking after recent outperformance. Again, this is rotation, not panic selling. The lesson here is simple. Price alone is not information. Price plus volume is. Now let's address the elephant in the room: flows. Domestic institutions continue to provide a cushion. Their steady participation is preventing sharp breakdowns. But foreign institutions remain cautious. This imbalance explains today's market behavior perfectly. DIIs support. Retail participates. But FIIs do not chase aggressively. What does that mean for you? It means rallies can happen, but they must be traded tactically, not emotionally. Until FIIs flip decisively, respect resistance as much as support. Tomorrow morning, the FII-DII data becomes critical. If FIIs show reduced selling or mild buying, confidence improves. If selling accelerates, protect capital first. Daily chart: Nifty. Structure. Recovery attempt from demand zone. Bias: neutral to positive above 26,000. Risk: failure below 26,000 shifts control back to sellers. Hourly chart: Nifty. Structure: choppy, overlapping candles. This tells us institutions are waiting for confirmation. Use hourly only to confirm, not predict. 15-minute chart: Nifty. This is your execution frame. Higher low above 26,000 is equal to buyers in control. Lower high below 26,000 is equal to caution. Now BankNifty. Daily structure remains range-bound. Hourly needs a breakout above 59,700 for momentum continuation. 15-minute decides intraday bias around 59,300. Key levels: educational, never advisory. Write these down. Don't memorize, write them. For Nifty. Resistance: 26,150 to 26,300. Pivot: 26,000. Support: 25,750 to 25,700. For BankNifty. Resistance: 60,000. Pivot: 59,300. Support: 58,700 to 58,400. These are decision zones, not predictions. Let price tell you what to do. Today's rally was relief-driven. Relief rallies are fast and fragile. If buyers show conviction early tomorrow, momentum can extend. If hesitation appears near pivots, profit booking follows quickly. Your edge is not forecasting. Your edge is reacting faster than emotion. Overnight, keep an eye on global yields, dollar movement, Asian market tone. Domestically, any commentary around macro data or liquidity can influence sentiment. Into the weekend, traders also reduce risk, so volatility can increase late in the session. Bullish scenario. Nifty holds 26,000, builds acceptance. BankNifty stays above 59,300. Breadth improves. Bearish scenario. Nifty loses 26,000 early. BankNifty slips below 59,000. Stops get triggered. There is no third scenario. Focus on stocks that show relative strength. Hold above VWAP. Confirm with volume. Avoid chasing gaps without confirmation. Pivot plus volume. A pivot without volume is noise. Volume without structure is chaos. Together, they create clarity. Tomorrow revolves around 26,000 on Nifty and 59,300 on BankNifty. Respect these levels. Trade light. React, don't predict. I'll be back tomorrow with the quick weekly brief and annotated levels. This is Market Insights by Nersu, calm, structured, and disciplined.